We're in the middle of earnings season and everyone is focused on AI and hyperscaler names, the Metas, Microsoft, Apples, and Amazons of the world. And for good reason. Collectively, those four companies represent nearly 20% of the S&P 500, and their quarterly results have the ability to move markets and change the investment narrative for the rest of the year overnight. But if you've been following this channel for any amount of time, you know I like to go beyond the headlines and look where others are not. That's why in today's video, I want to talk about two companies that just released results but aren't making headlines. There's money to be made following growth, of course, but there's also value in turnaround plays, and that's what I want to look at today. Two American industrial giants, two turnaround stories, two different playbooks. Today, I'm going to be breaking down Boeing and UPS so that by the end of this video, you can decide if it's worth your lunch money. Let's go ahead and get started. Starting with Boeing, who reported mixed results. I'm going to cover the good first and then the bad later. So first, the good. Revenue was up 8% year over year to $24.6 billion, beating expectations of $24 billion. They did this by delivering 171 aircraft, their best delivery rate since 2018. Free cash flow for the quarter was even better than expected, hitting $631 million. Wall Street was bracing for a free cash flow loss of $177 million. These are the kind of surprises I like. On top of the positive and surprise cash flow, the next few quarters look good too. The order backlog book now sits at $715 billion. That's years worth of work already sitting on the books. Now, that's already a great quarter. But wait, there's more. Boeing also got good news from the FAA. The FAA handed Boeing back its authority to sign off on its own safety inspections for the newly built 737 and 787 aircraft. That authority had been stripped away back in 2018-2019 following the tragic crashes that happened. The turnaround at Boeing is clearly taking shape and the future looks genuinely positive for the company. But it wasn't all good news. It wasn't all sunshine and rainbows for the quarter. Net income for the quarter on an adjusted basis came in at negative 76 cents per share compared to expectations of negative 30 cents per share. The relative good news is that this larger than expected loss was attributed to one-time items. They had $280 million in cost overages related to the Air Force One program, and they were hit with a nearly $5 billion charge-off related to delays on the 77X program. These are big but largely one-time items. Now, on top of the negative income, they also got a warning from the FAA. The FAA recently flagged improperly installed seats on 453 airplanes in the 737 MAX family. So now they have to go back, inspect, and fix any and all issues associated with those airplane seats. And that's obviously going to cost time and money, which no one is excited about, but it needs to happen. That said, I think the bigger takeaway for this quarter, and really over the last 2 years, is the cultural shift that's happening in this company. This is the company, after all, that built the B-17 and B-29 bombers, the planes that helped us win World War II. For years, this company has been plagued by CEOs who came from finance and consulting. These people couldn't engineer their way themselves out of a brown paper bag. But now things are changing from the top, with CEO Kelly Ortberg, who's been at the top job for about 2 years now. This guy is an actual engineer and bringing engineering back front and center of the company where it belongs. I know it's been a long 6 years of chop for shareholders, but I think Boeing, the company, and the stock are in a real position to make a nice move up over the next few quarters. Kelly's been in the job for around 2 years, but I think by the end of year 3, we're all going to be wishing we bought a lot more Boeing. Anyways, turning over to UPS now. UPS revenue rose 6% year over year to $22.8 billion, ahead of the $21.8 estimated by analysts. Adjusted earnings per share came in at $1.76, beating expectations of $1.66. But net income that's attributable to shareholders, that was down 50% to $604 million, down from $1.28 billion a year ago. The bigger story is the breakup with Amazon that's been taking place over the last few quarters. UPS has walked away from roughly $2 million in lower margin packages, which obviously strips out that revenue, but also has the benefit of reducing the cost of those lower margin packages. This is the company deliberately choosing to be smaller, leaner, and ultimately more profitable. They're betting that this lean structure will pay off big when volumes eventually come back. And there's already early signs that this bet will pay off. Domestic revenue rose 6% year over year, driven by a jump in revenue per package, which jumped $3 to $28.55. That's why it's more expensive to ship things at UPS. Now, during the call, the CEO made a very interesting comment. They said if you strip out the Amazon volume UPS intentionally gave up, the business actually grew. Now, they're basically saying if you ignore all the bad parts of the company, things are actually going pretty well. And that sounds pretty crazy, but there is some truth to it, right? Adjusted operating margins increased to 9.2% compared to 8.8% a year ago. The leaner structure is already working, and full year guidance for 2026 was actually revised higher for both the revenue and earnings side based on what they're seeing. Now, I want to pause a bit here and zoom out. Neither of these companies have anything to do with AI, and that's exactly what makes them worth watching. Boeing's growth is coming from long cycle CapEx backlog, not current demand, while UPS is growing revenue and margins even as actual package volumes soften and are projected to soften for the third quarter. Take both of those together and you get a corporate environment outside of AI that's leaning on pricing power and cost discipline to hit its earnings metrics, not a surge in underlying activity like what we see in the AI data center space. Two companies, two industries, two very different stages of turnaround. Neither story is finished quite yet. But if you're picking a side on the runway, Boeing's engineering-led culture reset, backed by a record backlog, is the story I'm most closely watching. Anyways, that's the breakdown for today. If you found this video interesting or mildly informative, please consider subscribing to the channel. It shows me that there's an audience for this type of analysis. As always, I'll see you on the next one, and of course, protect that lunch money.